Hi, you guys. I'm Phil Town from Rule One Investing, and today I want to talk to you about a few warning signs to look for before you go running off and buying a bunch of companies that you think have crashed and you think they're on sale. So let's kind of dive into that today. As many of you guys know, the basic founding principles of Rule One Investing is to buy really great companies when they're on sale. And this takes an enormous amount of the risk out of investing because essentially we're buying $10 bills for $5 and someday we're going to be able to sell them for $10. So the key in Rule One Investing is to wait for an event, and then when things drop their price well below their value, we'll be able to move in and buy. But all of that is predicated on knowing what you're looking at, being able to figure out what kind of company you want to buy, looking out into the future. So one of the big problems that people have as we have a really severe event like we're going through right now with this COVID pandemic is that seeing the future clearly is simply impossible. There's nobody that can tell you how things are going to work out as the entire world economy slows down, darn near shuts down, in something that's unprecedented. We've never seen anything like this in modern history. As a result, we can buy things that look like they've dropped into their margin of safety area, but we have to do it only with companies we really do understand well. So let me go over a few things here that I think are super important to understand when you're looking at a company that maybe is a bad one to buy into. The first thing you've got to look for in this kind of an environment where the uncertainty level is screamingly high is if the company has debt that it's going to have to refinance anytime in the near future. And by near future, I mean anytime in the next 4 or 5 years. And what that means is everybody's debt. All corporations have debt that will need to be refinanced in 4 or 5 years if they have debt. So then you've got to look and see what relationship is there between the debt and the earnings of the company. Now, earnings are our typical way of looking at this, but I'm going to tighten that up right here and tell you guys that you really need to look at free cash flow as the basic denominator to divide into the debt of the company. And that's how you'll see how long it would take to pay off this debt out of free cash flow. So what you do is you figure out what's the operating cash in the company, and this is just a simple line on the cash flow statement that they produce every single quarter, every year. It's called operating cash or cash from operations. And from that, you subtract all of the capital expenditures, which is a line right down below that in the investing portion of the cash flow statement. And typically it's called purchase of property and equipment. So subtract that purchase of property and equipment from operating cash, and what you get is free cash flow. Now divide that, don't you love the math? Divide that into the total long-term debt, which is a line on the balance sheet. So if you can't do this in your head, then this is probably too hard. This is really simple math. It's really going to be like just round everything off, ballpark it. Okay, you don't have to get it to the digit. So if you've got $100 million worth of operating cash, and it's really some more tidy number than that, then just take 100 million. And if you've got 50 million in operating or in PP&E or purchase of property and equipment, then what you have left is $50 million of free cash flow. Now, divide that into the debt. Let's say the debt is $1 billion. You divide 50 into $1 billion, you get 20. That's 20 years to pay this off. That's not something you want to get involved with. If it's about 2 years to pay it off, that's okay. So, for example, if they have $100 million of debt and $50 million of free cash flow, then it's about 2 years to pay it off. Now, here's the catch. The free cash flow of this company is almost certainly not going to be what it was last year. It's going to be less. And this is why it's so important that you understand the business, which means it's got to have a big moat. If you have a business with a big moat, then there's a decent chance that the free cash flow will continue, that they have the ability, because of a niche business that everybody needs, they've got the ability to recover quickly from a big downside here in the global economy and be able to sustain some level of free cash flow. So for some period of time, it might, be $10 million of free cash flow into $100 million of debt. Looks like it's really huge, but if you understand the business, you'll know that they're going to come back with the economy in 4 or 5 years. So it's going to be a judgment call. What that means, obviously, is that the easiest judgment call of all is a company that has no debt. That's our preferred thing to buy. So I would say if you're a novice at this, I would steer away from companies that have any debt at all. Just go for the ones that have no debt. All right, the next thing I want you to look for is management that's bad at allocating capital. And I would look for companies, if I wanted to judge whether management was good at allocating capital, I would look to see if they've been buying back stocks when their stock price is at the record level they've ever been at. All right, so if the stock price is massively high and they're buying back their stock, these guys are morons at managing their own capital. And that means that they're probably going to do a bad job. They're probably going to be looking for some way to protect themselves in this great global depression. They're not going to be thinking altruistically. They're not going to be thinking about you as an owner. They're going to be thinking about themselves. And that means they may just take this into Chapter 11, bankruptcy, before they ever had to, just because they're not good allocators of capital. So a couple of things here, right? We'd like no debt. We want management to be allocating capital properly, meaning that they're not buying back their stock when it isn't cheap. We want to ensure there's a big moat. If there's no moat, we don't like this company, because if they're going to compete on price, they could be in real trouble here. A real good example of that is the oil companies right now, and they're all in trouble and they all have debt, and we're not getting anywhere near them. And finally, there's figuring out what is the real value of this business over the next decade. So we're going to assume that the business is going to go through a bump here, maybe a big bump, and it's going to come out of it with the rest of the economy because it's a big moat company and it doesn't have any debt. It's got good management. It comes out the other side. How do you figure out the value of that business? Well, the major way to think of it as just say, okay, well, we're going to estimate things go really badly for 2 or 3 years, and then they start to pick back up, and in 5 years, it's roughly back to where it was now, which would be fairly typical of a big recession. And in 5 years, we go on for the next 5 years at a decent growth rate, and then calculate the value of that company in that way. If you want to do it using a 10 cap, it's much more difficult right now because we just don't know what the operating or what the owner earnings are going to be of the company. So if you're not sure that you can figure out the value, then here's what I would recommend very strongly. You just be patient and wait. Don't jump in there on something you're not sure about the value over the long run, okay? Because here's what can happen is over the next year, this stock market could tumble another 30% or 40%. It could be down overall from the Dow Jones Industrial Average at 30,000 back in February. It could be cratering down to a Dow of about 15,000 if it's just a bad recession. If we're in a depression worldwide, and we may well be, then the stock market could do what it did in the 1930s, and that is crater all the way down to maybe 80%. I don't know that it'll go to 90, but let's say 80% of the value of the market disappears. That means 80% of 30,000, or rather 20% of 30,000, which would be about 6,000, where it was in 2009 at the bottom. So we would lose an entire decade of market value. Really, we would lose a lot more than that because we were at 11,000 back in 1999. So we could be seeing a really major meltdown here, and I want you to be able to take advantage of that. So don't be in a rush to jump in on something that you don't fully understand. Being in cash for a year or two right here won't hurt you. Yeah, you're going to have potentially inflation, but that's not on the horizon right now. Right now, everything's looking very deflationary. That means cash is king for another little while until the Federal Reserve pouring money into the economy results in inflation starting to build up again. But right now, I would say we're deflationary. Right now, cash is king. Right now, be very wary of trying to get a bargain. Just sit tight. And I think a year from now, you'll be really glad you did. And if you have cash a year from now, you may find you're able to pick up things that are 70% discounts to their current price. And man alive, that means there are going to be some fabulous companies that are bargains. So what should you do now over the next year? You should study your little tail off and really understand how to pick a great company. Learn, what am I capable of understanding? What does a solid moat look like in the future economy? What management team should I invest with? What are their values? Do I trust them? And finally, how do I figure out the real value of this business if we're going to go through a huge crash here? And when you do that over the next year, you're going to have a great watch list that you'll build based on that information. And you guys, you're going to be in a position to just massively kill it as we come out of this next big mess. And we will. I don't have any doubt in my mind. America is the strongest nation in the world economically. When we get a cold, everybody else gets pneumonia. So when we get pneumonia, you don't want to be anywhere else. You want to be here. We'll survive. So with that, I'm going to say it's really important that you guys think about this really seriously. I want you to think about what companies you're kind of eyeballing right now to invest in. Do they, run into some of these or all of these qualifications that you're capable of understanding? It's got a big moat, good management, and it's on sale. And if so, how do you know? Leave a comment below. I'd really love to follow up with you guys. I think we could all help each other here a little bit by looking at some different things and commenting on them. And I just want to tell you, thanks for watching. Now go play. Hey, listen, if you enjoyed this video and you think it was valuable in teaching you more about how to evaluate companies during a stock market crash, hit the like button and please share this video with your friends. And if you want more investing content, just subscribe to my channel. We got a lot going on here. And don't forget to click on the button. There's a free gift right there. And thanks again for watching.